Have you ever looked at the stock market and just felt completely lost? After the last few years of dizzying highs and, let's be honest, gut-wrenching lows, it's so easy to think the whole thing is just a giant, unpredictable casino. You see the headlines, you hear the stories, and you start wondering, is this even worth the risk?
And you know what? That is a totally fair question, one that almost every single new investor asks. Especially after a big market downturn, a lot of people feel burned, and they decide, nope, never touching a stock again. But what if I told you there was a way to invest that wasn't about gambling at all? A way that was about a deliberate, careful strategy designed for safety and steady, reliable returns. Well, that's exactly what we're going to dive into today.
Welcome to another video on investment basics. Now, the principles we're discussing today are all grounded in the work of Mr. Majid Butt. He brings this really unique perspective as an accountant, a software programmer, and a dedicated investment researcher. His whole approach is about cutting through the noise and giving you a clear, logical framework to invest with real confidence.
So here's our game plan. First, we'll cover why you'd even want to own stocks in the first place. Then we'll get into 4 powerful rules for investing safely. After that, we'll talk about the big one, the growth stock trap, and how to avoid it. We'll also look at the power of consistency. And finally, we'll wrap it all up by helping you build your own personal plan.
Okay, so before we jump into the rules and the how-to, let's start with the most basic question of all. Why should we even bother owning stocks? Seriously, understanding this is the bedrock, the key to sticking with your strategy when the markets inevitably get a little crazy. I love this old Turkish proverb because it perfectly captures how so many people feel right now. The market crash was that hot milk. It was painful, and now a lot of investors are so scared they're treating all stocks like they're scaldingly risky. But here's the paradox. The very act of crashing has actually taken a lot of the risk out of the market. What was hot milk before might just be room temperature yogurt now. The real question isn't what happened in the past, but whether stocks are priced reasonably enough to offer good returns in the future.
So why stocks? Well, historically, the argument boils down to 2 huge advantages they have over something like bonds. First, stocks give you real protection against inflation. As everything gets more expensive, the value of your cash shrinks. But stocks, they represent ownership in businesses that can raise their prices, helping your wealth keep pace. Bonds don't do that. And second, stocks have simply delivered a higher average return over the long haul, thanks to dividends and companies reinvesting their profits to grow bigger.
But, and believe me, this is a huge but, all those benefits can be completely wiped out by the single biggest risk in stock investing, paying way too high a price. I mean, just look at the 1929 market peak. After that historic crash, it took a full 25 years for the Dow Jones to climb back to where it was, a quarter of a century. So when you hear people say they're investing for the long run, do you realize just how long the long run can actually be? This is the kind of disaster we need a strategy to protect us from.
And that brings us right to the heart of what we're talking about today. To avoid the fate of those poor souls who bought at the 1929 peak, a defensive investor needs a simple, clear framework. Think of it like building a fortress of safety around your money, using 4 straightforward, common-sense rules.
Okay, here they are. Number 1, diversify your stocks adequately, but not excessively. 2, stick with companies that are large, prominent, and financially conservative. 3, insist on a long, continuous history of paying dividends. And 4, the one that directly tackles that 1929 problem. You have to put a strict limit on the price you're willing to pay. Now let's break each of these down.
First up, diversification. This is probably the oldest rule in the book, and for good reason. You simply don't want your entire financial future riding on the success of one single company. By owning somewhere between 10 and 30 different stocks, you spread your risk out. If one company hits a rough patch, it doesn't sink your whole portfolio. This is your first, most basic layer of protection.
Rule 2. What kind of companies are we looking for? We want businesses that are large, prominent, and conservatively financed. Okay, prominent just means it's a leader in its field, and conservatively financed is something we can actually measure. We want the company's debt to be less than half of its total capital. In plain English, this just means the company isn't drowning in debt, which makes it way more likely to survive and thrive during tough economic times.
Now, what's really cool about this next rule is that it's like a secret signal of a high-quality company. By insisting on a long history of paying dividends, say for at least 20 years straight, you learn 2 things. 1, the company has been profitable enough to consistently share those profits. And 2, it shows management is disciplined and committed to its shareholders. Go back to that 1929 example. For patient investors who reinvested their dividends, their returns were actually positive over that horrible period, all because those dividends provided a steady stream of cash. And finally, we get to the most important rule for avoiding a catastrophe. You must limit the price you pay. This is where discipline is everything. A really simple but effective rule of thumb is to not pay more than 25 times a company's average earnings from the past 7 years. This forces you to be rational. It makes you buy based on proven, long-term profits, not on some speculative hype about the future. It's a simple calculation that can save you from a world of hurt. Just by following that fourth rule, you automatically avoid a very popular and very dangerous category of stocks. This brings us to a critical warning for every new investor out there: the growth stock trap. Let's take a look at why the most exciting, most talked about companies are often the riskiest ones to own.
So here's the core difference. The defensive stocks we've been talking about are big, stable, and you buy them at a reasonable price based on what they've already earned. A so-called growth stock, on the other hand, is popular, it sells at a really high price, and that high price is based almost entirely on speculative hopes and dreams for the future. The problem is, the future is always uncertain, and paying for hopes and dreams isn't investing, it's pure speculation. And if you think this only applies to some flimsy little startup, think again. Even the bluest of the blue-chip growth stocks can get crushed. The legendary IBM lost half its value, twice in the 1960s. More recently, Microsoft dropped over 50% between 2000 and 2002. Or look at Texas Instruments, which saw its stock price soar right before it crashed by 80%. History shows us again and again, the hotter they are, the harder they fall.
So, if chasing popular growth stocks is a trap and trying to perfectly time the market is basically impossible, what's the alternative? How can a normal person invest successfully without needing to be a full-time financial wizard? Well, the answer lies in a simple yet incredibly powerful technique that actually turns market volatility from a threat into a major advantage.
This technique is called dollar-cost averaging, and the idea is just wonderfully simple. All you do is invest a fixed amount of money at regular intervals, like say $200 every single month, no matter what the market is doing. This simple discipline has a powerful side effect. When stock prices are low, your $200 buys more shares. When prices are high, it buys fewer shares. It automatically forces you to buy low without you ever having to predict anything. Let's see just how powerful this is in the real world. During that brutal bear market from 2000 to 2002, the S&P 500 index fell by a staggering 41.3%. But an investor who just kept putting in the same amount of money every month, their account only fell by 30.2%, a much softer blow. And even better, they were loading up on more and more shares at bargain bin prices, setting themselves up for a massive recovery. In fact, even during the Great Depression, someone who invested just $100 a month starting in 1929 would have seen their money grow to over $15,000 10 years later, while a lump sum investor would have been sitting on a devastating loss. Okay, so now we have our 4 rules for picking the right stocks, and we have a consistent strategy for buying them. So for our final section, let's bring this all home. How do these principles apply to you in your specific life? Let's talk about building your personal plan. So, is this strategy only for one type of person? Absolutely not. Think about a widow who needs safety of principal and a conservative income, or a successful doctor who has plenty of money but almost no time for in-depth research, or even a young professional just starting to save. Their financial situations are completely different, but the defensive approach is the logical, prudent choice for every single one of them. See, the right kind of investor for you to be doesn't depend on how much money you have. It depends on your knowledge, your experience, and your temperament. And that really brings us to the final question. After walking through this framework of prudence, discipline, and consistency, you have a choice to make. Are you going to be a speculator, chasing hot tips and popular trends, just hoping to get lucky? Or will you choose to be a defensive investor, building your wealth methodically and safely over time, protected by a set of simple, timeless rules? The choice is entirely yours. This framework is the key to building that durable, long-term wealth. If you found this approach helpful and want to go deeper into its practical application, you can subscribe to my membership. There, you can access exclusive videos on the analysis of financial statements of public limited companies listed on stock exchanges around the world, which aren't available to others. Thank you so much for watching.